Hello.
Welcome to the Marsh webinar, Decoding Property Risks. We'll be starting our webinar in a couple of minutes. Once again, a very warm welcome to the Marsh webinar on Decoding Property Risks. We will start our program in less than a minute. We have a number of participants logging in as it's 4:02 and we kickstart our webinar. This is Sanjay Kedia, Country Head and CEO for Marsh in India. Welcomes all of you for the Marsh webinar, Decoding Property Risks. You all have an opportunity to raise a question or a comment throughout our webinar. Please feel free to raise your hand and If you have any comment and questions at any time, please share. We would be running some polls. Please do participate. Next. Our speakers, we are pleased to have Glenn Eaglestone. He is our Asia leader for the claim solutions and forensics. He's also an expert and leader on the business interruption insurance. Paul Wilkins, leader for our risk management, large clients based out of Hong Kong. Pranav Patel, leader of our India client service. And Inayat, he's a senior colleague in our risk consulting team from Marsh India, who has done numerous property site visits on the risk engineering programs. Before I hand over to Pranav, my colleague, I wanted to share a few thoughts and comments on the property risk. It has been a tough last 2 years for the clients globally on the property risk. We have seen property risk insurance rates rising globally very significantly. And a very unique development in India, we are all aware, in the form of movement of the risks to more like a fixed rate in the form of IIB rating. And this rate increase has been very high for certain class of industry, pretty much high, almost ranging from 3 times to 9 times for many class of business. The challenge in India is that the free market price discovery is almost gone, and that is not good for the policyholders. In India, we also have a challenge that the customers do not have a choice to select their deductibles to higher levels beyond a particular level. The coverage has limited choice in form of wording, and even the customers cannot select the limits. As soon as you step outside India, the clients do face the challenge of property premium rate rise, but they have these tools to manage their exposures and risks in a different way, and particularly the cost. We have seen in India, under the IIB regime, customers have looked at different kinds of rationalization in terms of rationalization of cover, focusing on the occupancy code, cross-subsidization of premium from other lines of business, particularly medical and marine, to manage the cost. But these are inefficient ways in a limited way, and I hope the regulator supports bringing back the free market, which the entire world has, and India should also move to that area. So that's something which we support our clients' quest for that, and we have a new chairman of insurance regulator waiting to be announced any time, and then we will see what direction the new chairman of the insurance regulator takes. It is important that policyholder remains active and continue to represent their cause in all forums because that will really help. Marsh is committed and continue to raise voice in the interest of the policyholders. For today's program, we also have Inayat, who will be sharing some of the focus on how various clients are focusing on the risk improvement, which is a long-term and also in the short-term does help in improving both your risk premiums. With this, I hand over to my colleague Pranav, who will share his thoughts, and then we will invite Glenn to share comments on the business interruption, which is a growing interest globally and in India. Pranav, over to you.
Thanks a lot, Sanjay. Now, in times of the pandemic, in the last 1.5 years, we have seen nearly every industry has been impacted, ranging from manufacturing to hospitality. Revenues have taken a hit. Business interruption has really become the talking point. And, irrespective of whether insurance exists or not, there are certain things that we need to take care of from a property standpoint, whether it's property insurance coverage or property risk control. So in today's session, Glenn Eaglestone will be talking about some of the finer aspects of BI insurance. He'll also be sharing some tips that need to be borne in mind when renewing your business interruption insurance policies. Paul will be speaking about managing emerging risks. We've clearly seen, the evolving risk landscape. We've seen, new risks coming to the horizon. The prioritization of risks has clearly changed. Risks like cyber, non-damage business interruption have come on the forefront, whereas the traditional risks have taken a bit of a backseat. I myself will be talking about some of the new clauses that have been introduced in the market by underwriters to protect their balance sheets for any undue exposure because of either property damage or business interruption resulting from communicable diseases. I'll also be talking to you about the concept of total cost of risk. We at Marsh have strongly advocated this concept to look at risk management holistically rather than just premium and deductible. So the TCOR concept, as it's called, allows you to look at risk management on an overall basis and take a conscious decision when it comes to risk retention and risk transfer. Inayat, our property risk control leader, will be talking about some of the latest trends in property risk control. And he'll also be sharing some of his experiences in the last 1.5 years, where we've had fewer people on the ground, lesser maintenance, lesser inspection schedules being executed. So this will be addressed by Inayat in some time. After that, we'll be having an open house in which Sahil will conduct a panel discussion and Q&A. On this note, I'd like to invite Glenn Eaglestone to speak about business interruption in a COVID world. Over to you, Glenn.
Thanks, Brenna, and good afternoon, everybody. Today, I'll be giving a little insight into business interruption and some of the challenges experienced during the COVID period. I'll start with providing a summary of what business interruption insurance is and why it's important to businesses. I'll touch on the recent FCA test case result in the UK. And then I'll move on to discuss the usual core considerations of business interruption coverage. The implications of COVID on the business interruption coverage requirements has been significant, depending on the industry. So I'll provide a brief explanation of the specific COVID aspects we need to consider. And then I'll wrap up with a few tips on renewing your business interruption program. So let's start with what is business interruption and why is it important? So move to the next slide, please. Insurance is a type of risk transfer. The usual way to transfer property risk is through a property insurance policy. There's a variety of terms used in different countries to describe this type of policy. The IAR, industrial risks, industrial special risks, or simply PDBI. The property policy is usually split into two main sections. Section 1 covers damage to physical assets, so building, stock, plant, and the like. This is generally called either property damage or material damage. And they mean the same and can be used interchangeably. Section 2 covers damage to income or profit, which is non-physical. Depending on the region and the underwriter, we can see different terminology used to describe Section 2. The usual term is business interruption, which is often simply referred to as BI. But we'll often see the term consequential loss used, as well as time element, which was introduced by insurers such as FM Global or affiliated FM, but is occasionally used now by other insurers as well. Each of these terms is appropriate depending on the type of policy in question. They all give an expression to different types of the same thing, and we tend to use them interchangeably. Another way of looking at the policy structure is that the balance sheet of the business is protected by Section 1, and the profit and loss account is protected by Section 2. A property policy is known as a policy of indemnity. The intention is to put the claimant back in the same financial position they would have enjoyed had the damage not occurred. It's important to appreciate that a property policy doesn't simply provide cover for a potential fire, flood, or earthquake, but rather provides cover for the damage that's caused by a potential fire, flood, or earthquake, including the BI suffered in consequence of this damage. It's a subtle, but it's an important distinction. The principle of indemnity is important because it's a fundamental principle that can be referred to in the event of a dispute regarding the interruption or the application of the policy. Next slide, please, Frank. There are many surveys and reports issued each year in the insurance and risk sectors, including the World Economic Forum Annual Global Risk Report that's sponsored globally by Marsh. Many of these reports rank the most important risks affecting businesses each year. The Allianz Risk Barometer is one such survey. Having been the most important risk for the last few years, business interruption was knocked off top spot in 2020 by cyber. Business interruption was just as important as previous years. It's just that cyber is becoming more front of mind now for so many businesses that it's caught up BI and slightly overtaken it. However, this doesn't diminish how important BI is to businesses. The average insured BI loss from a fire is now around $6.7 million US, which is 45% higher than the corresponding property damage. Losses at customer and supplier premises, known as contingent business interruption or CBI, are larger and more widespread than in previous years. In many industries, there's highly efficient global supply chains, but this increases the company's vulnerability to CBI events. The underlying purpose of business interruption insurance is to provide the essential cash flows to support the business in the event of a loss, essentially to fund the business continuity plan. If BI insurance is not adequate, in the event of a large loss, the continued survival of the business is put at risk. All this means that it's more important than ever to have an appropriate business interruption cover. And with BI having a more significant impact on the business, it's not surprising that more and more companies around Asia are now choosing to provide or to purchase comprehensive BI cover. The next slide, please. One of the most significant changes to business interruption landscape over the last 20 years has actually occurred in the last year or so. As a result of COVID losses in the UK market, the insurance industry went through a fast-tracked legal test case in order to provide prompt guidance on specific COVID queries. It's important to recognise that the results of the UK test case do not necessarily impact on policies written in India, as you have a different regulatory environment and you have different wordings. However, there were a few interesting conclusions that are worthy briefly of sharing, just for interest purposes. So firstly, where there are cases of wide area damage, often arising from NatCat disasters rather than COVID, although the effects are similar, we usually refer to a legal test case or legal case called the Orient Express Hotels case. This would limit the insured's ability to recover losses arising from damage to insured property. But we'd have to ignore the wider effects of the actual event. However, the FCA test case challenged the conclusions of the Orient Express Hotels case, concluding that it was not reasonable to limit recovery just because other property has been damaged once the policy conditions have been met. This would mean that with a COVID claim, in theory, all losses arising from COVID are recoverable once the policy conditions have been triggered, even if you would have suffered many of those losses anyway due to the wider pandemic. A second conclusion from the FCA test case concerned the required notice by a public authority to close. It was concluded that there was no need to have a direct link between the notice and the specific business. For example, having a government instruct everyone to close in a particular suburb or city is enough to trigger that part of the policy requirement, with no need for the insured's business to be specifically named. The third conclusion relates to the prevention of access trigger required to complete the prevention of access to the whole business, or whether the partial prevention was enough. The FCA test case concluded that a partial prevention was enough to allow a claim to be considered. So, for example, it might just be part of the restaurant that's closed and you can still do takeaway. It doesn't have to be the complete restaurant. There were many other conclusions reached, but we don't have time to go through all of those scenarios today. As noted earlier, there have been COVID test cases in the UK, Australia, Ireland, the US, and many other regions around the world. However, the conclusions from those test cases do not necessarily impact clients in India, as your wordings are different and you've got your own regulatory framework. Therefore, be careful not to draw conclusions from other regions and seek to apply them in your own country. Next slide, please. So with that background, I'd just like to discuss the usual core considerations for BI cover. We'll start with average. The average clause is used by insurers to limit claim payments for those policyholders who've not appropriately insured the BI risk. As an example, if your declared value is $80, but following a loss it was determined that your declared value should have been $100, then you'd only get 80% of your claim paid. This means it's important to get the declared value right to avoid the average penalty. When considering your sum insured or your declared value, there are various elements you need to get right. Firstly, what type of cover is best for your business? This could be gross revenue for those businesses with very few variable costs. It could be standing charges for those businesses that do not want to insure their net profit. They only want ongoing fixed cost cover. Or maybe it's additional increased cost of working only for those with limited exposures to revenue losses. Or the cover that suits the majority of businesses is likely to be gross profit. Gross profit cover, when applied correctly, is designed to put the policyholder in the same financial position as if the insured loss did not occur. Secondly, what are your revenue projections? You need to consider growth until the end of the maximum indemnity period. With a 12-month indemnity period and assuming a loss occurs on the last day of the policy period, you need to forecast revenue for at least the next 2 years. And finally, you need to consider the appropriate split between fixed and variable costs. This will help ensure you don't suffer uninsured losses in the event of a claim. The third element to consider is the maximum indemnity period. This is the period of cover chosen under the business interruption policy, and the length of the period is a decision for the policyholder. Even though 12 months is standard for many industries, this is often not sufficient. Many businesses require 24 or even 36 months to ensure that they've got sufficient period of cover to actually recover the business. So we'd like to now think about what's different in the COVID-19 world from a business interruption perspective. The next slide, please. Here we have a chart with the objective of identifying some of the challenges faced with estimating the effects of COVID-19 on the business interruption value of the business. On the left, we have the start of COVID-19. In reality, the effects of COVID-19 would differ widely to the simulation depending on the industry you're in. The sudden onset of COVID-19 pandemic has affected businesses in a variety of ways. There's rapid increases in activity for some, thinking about supermarkets or logistic companies. In some, there's actually very little or minor changes. So you might think banking. Banking has certainly gone through changes, but has the fundamental implications of banking been changed? However, we're seeing many significant negative impacts with many closing business units or locations. It's especially true in hospitality and travel, although there have been many other industries badly affected. The first challenge in considering your business interruption value is to try and estimate when the recovery will start. This will be different depending on the industry, the location of the business, and also the location of the business's customers. The next challenge is to estimate the rate of recovery. Will it be a slow, steady recovery, shown here with the red line? Or will there be a little more gradual growth, maybe shown with the blue line? Or will the business be fortunate enough to be in an industry and location that will recover relatively quickly, with growth returning to pre-COVID days? Other questions that would need to be asked include whether you've mothballed or permanently closed some of your locations. Do you have an increased reliance upon a few customers or suppliers? How are they coping in the COVID-19 world? Have your payroll costs changed significantly, either up or down? In order to estimate the BI declared value, you need to consider the likely effect of all these challenges on the business. Next slide, please. So what happens if it goes wrong? We've got the same simulated data here, but let's assume that the business suffers an insured loss near the bottom of the COVID effects. Let's assume that there's a reasonably long indemnity period. You can see now why it's important to try and predict how the business would have recovered and how quickly it would have recovered. If you assume a low recovery when preparing your BI declared value, which is the red line, but then other post-loss data suggests that it should have actually really been a high recovery, which is green, then it's likely your claim assumptions will significantly exceed your declared value, and therefore you're going to be underinsured. Having been through arguably the most challenging period for any business during COVID, the last thing your business needs is to suffer an insured loss and find you have inadequate cover, with all the potential upside from a recovery being removed from the claim due to the application of average. So what does that mean for your business interruption program? Next slide, please. Here are a few tips for renewing your business interruption program. So firstly, make sure your maximum indemnity pool is sufficient. Failure to do so could result in large uninsured losses. Secondly, when considering growth, try to predict the future recovery of your business. You should consider a possible loss at the end of the period of insurance. Estimate what growth might be achieved both during the period of insurance and throughout the maximum indemnity period. And remember that these conclusions are likely to be different for each industry and even in each country in which your business operates. Thirdly, what rate of gross profit would you expect? Would this be the same as pre-COVID-19? Or will your normal cost of business have changed, either up or down? Many businesses are operating in what's becoming known as the new normal. But what does that actually mean for your business? And then finally, if required, get expert assistance if you're not sure what to do. So I think we now move on to the first poll question. Okay. So how confident are you of correctly capturing BI insured values of your business and the optimal indemnity period? If you could select one of the options on the screen, please. It's a good result. Fairly confident, 44%. Slightly doubtful, 30%. So 3/4 of you in the middle band, which is not surprising. But certainly in the current COVID world, there are certainly some challenges that you'll be facing now that maybe you didn't have to face 2 or 3 years ago. So with that, I will pass on to our next speaker, who I believe is Paul Wilkins.
Could we go to the next slide, Pranav? Yeah, okay, this one, great. Okay, great. Okay, so actually, interesting poll finding there. So, like, 49% of the group have some doubt that you can calculate an accurate BI number. So, with in some ways, it's not surprising. BI is complicated. And there's so many moving parts at the moment globally, the changes in the supply chain and how that impacts prices and all sorts of things to consider. So my one request around that is that if you do have doubts and you would like some help, please contact your Marsh team. The Marsh India team has people with strong expertise in this area, but also those colleagues have access to Glenn and other colleagues around the region. And we're advising many of our clients in Asia at the moment around taking a careful look at their business interruption numbers. So please don't hesitate to do that. So I think, I think many of you on the call are responsible for insurance or risk management or both. You're within your companies that are probably growing very quickly in India and probably growing very quickly internationally. So the risk arena is very complicated for you. We've just talked about the BI The property in itself is complicated. Pranav's going to talk about some of the restraints that you encounter in the India market and some solutions that the Marsh team has been working on. Of course, you worry about your general liability coverages and your employee benefits coverage. So all of those things that you've always worried about are still there and probably more complicated than they were. But in addition to that, Marsh sort of recognized that globally, we've layered on a whole additional level of new areas of risk, emerging risks, and risk complexity. So to help sort of uncover this, Marsh has recently done a survey of our clients on a global basis, and I know some of the clients in India have participated in that survey. We've called it a risk resilience diagnostic, and the intention of the survey is to collect some basic information from companies around the globe to enable us to give you a short and simple report, sort of benchmarking how you're doing against a global group or your peer group in India in relation to the way you're identifying and managing some of these emerging risk areas. So the risk areas that we determined that we would focus on, and this is of course not all of the emerging risk areas, but there are some core areas that we think are most relevant to most companies are, no surprise, cyber, climate-related issues. We hear climate every day now. Geopolitical issues, pandemic issues, emerging technology, and regulatory issues. So I think any one of those areas, we could spend the entire call in discussing how they're evolving, because we talk about them today and they probably will have changed by next week the way they're emerging. So let me just take, I really only have sort of 10 minutes, so I can only just do like an introductory thing. So let me just quickly go through each of those areas and just make a few comments that hopefully you will find relevant to your businesses. So cyber, yes, of course, we hear about this all the time, and Glenn pointed out that it's taken over from BI as being the area of concern of most risk management sized companies globally. And we read every day about the hacks, but interesting to think about the way this has evolved. First of all, companies were worried about people coming in and stealing their company IP. Then it kind of moved on to people coming in and stealing their client data, credit cards and all that type of thing. And then it kind of merged into privacy areas. Different regulators are saying, hey, if you lose client data, you're going to be responsible for privacy issues, and there's some liability issues there. Then it moved on to hackers demonstrating that they could actually impact control systems in manufacturing and shut down manufacturing. And then in recent times, it's really been all about ransomware. And we all read about, we all hear these cases. So you've got to assume that that is probably not the end of it. Cyber is going to continue to evolve as a risk area, so very difficult to keep on top. The insurance industry itself has a product. It's trying to keep up, but I don't think anybody can really keep up. So there is a product. It's not perfect. It can be fairly costly, but what we recommend to all clients is, at the very minimum, try and do a review to understand your loss exposures for cyber in the same way that you do for property and BI. And at least then you're then informed about the risk issues, and then you can sort of get on to how to manage them. So that's cyber. Climate, we could spend all day on climate, of course. Again, you'll see the news, we see the flooding in the US, tremendous flooding in China recently, and but every time there's these events now, they seem more severe. People talk about record levels of rainfall occurring in 24-hour periods, like 1 year in 24 hours was the recent one in Henan in China. So, there is a belief that weather-related events around the globe are becoming more frequent and more severe. So what we do have some, particularly financial institutions coming to us where they're investing globally, asking us if we can help them kind of look into the future and map areas that are likely to be most impacted by projected climate changes. So Marsh, and together with our sister companies, OW, Oliver Wyman, Guy Carpenter, can do some fairly sophisticated work in those areas. If you are over a long period of time expanding globally. But of course, climate is just part of the ESG framework, environmental, social, governance. So, apart from the climate issues, there are sort of racial issues, gender inequality, and governance. So it's a huge topic that I think we all kind of really hear about and have to act against every day now. So Marsh is spending a lot of time and MMC companies investing in talent that can able to advise companies around the risk issues related to, I guess, non-compliance with expected ESG standards. And of course, in the insurance industry, like the financial industry, has come out and said, okay, we don't want to insure any new coal projects. But again, you can see how this is expanding. From coal, it's moving to, we don't want to insure any new oil and gas pipeline projects. And bit by bit, we can expect to see this through pressure groups and so on to expand into further areas. So if you feel that you're in an industry which is maybe susceptible to that, I'd encourage you to work closely with the India team as to how you kind of develop your storyline for the insurance market. It may not be such an impact if you are working through the environment that Sanjay talked about in India, but if you have international exposure and you're using international markets, you're going to need to be prepared to talk about what you are doing around ESG when you present on insurance now. So this is a new area, again, that we can help you with. Geopolitical, vast topic. Obviously, we've just all followed what's happened in Afghanistan, a kind of surprising outcome. But high-level version is that the US is out and China and Russia and maybe some other countries are in. So what is the impact if you're investing in those areas, either in Afghanistan or in some nearby countries? But again, very complicated, evolving all the time. Marsh has a political risk group, which is constantly looking at those things. So again, if you're looking at investing globally in different areas and you suspect there may be changes, again, please come to the India team and we can help connect with our political risk group. And then the last few, pandemic, well, we're in the middle of it. It's, it seems to be a never-ending pandemic. So, realistically, you cannot insure for COVID. But there are opportunities to look to the future and say, well, when COVID is gone, are there other potential pandemics? And should we be thinking now about our risk control and our insurance around those things? Maybe you can buy insurance for future events, if not for COVID, but obviously a huge topic area. Emerging technology, we've got so much going on there. There's the use of AI, and AI is already demonstrating some bias and companies perhaps being liable for that. Robotics, it's developing every day. What are the risk issues around that? And autonomous driving, it seems like we can't get to electric vehicles and autonomous driving fast enough. And then finally, the regulatory environment. Sanjay at the start talked about how through the regulatory environment for insurance in India creates a sort of challenging situation for you that you all need to sort of, together work with and, to the extent you can sort of push back against and see how you can get some flexibility. Again, we see in the media in the last couple of weeks what's going on in China around regulatory changes. The technology impact is being controlled. Any companies with a lot of data are being sort of seriously controlled. It's moved on to gaming and education. So, these are all big changes being forced not only on Chinese companies, but international companies operating in China. And again, the belief is that that's sort of not the end of it. So, I think that's enough for all of us to be thinking about. But the messaging in, being a risk manager or insurance manager is a far more complicated job today than it was probably even 12 months ago. And it's probably going to get more complicated in the future. Marsh has a lot of resources to support any of you in many of these areas. So that's probably all I really have time to cover today, but hopefully there's some things of interest in there that you can follow up with the India team.
Thanks, Paul. Go on to the poll question too. So as we can see, a majority of participants do acknowledge that the pandemic has impacted claims administration, albeit moderately, not very adversely, but moderately. And there is also 19% of the participants who feel that it has had an adverse impact. But considering the times that we are in, where surveyors cannot reach the site on time, exchange of documents, carrying out the inspections, sharing of reports is becoming more time consuming than what it was. So this is very much in line with expectations that there's been a moderate impact on claims administration. However, technology has been the saving grace, and we've seen virtual surveys being conducted, insurance companies, relying on photographic evidence many times when physical evidence cannot be, shared, at short notice. So all of this has helped us, go on with claims administration, and it's been, I think we've all done the best we can, and so it's much better than what we could have been impacted during these times. Now, moving on to the impact of some of the clauses, I'll just be, displaying that slide. If you can just allow me to, yeah, here we are. So now, as I had mentioned earlier, insurance companies, to protect their exposure and some of the new risks that have come to the horizon that Paul spoke about, insurers have clearly tightened the screws on policy wordings. They've come up with new clauses to protect their balance sheets. So the most common clause that's been introduced across the board, across all property policies in our market, is the communicable diseases endorsement. And GIC and all other lead reinsurers insist on this clause to be there in property policies. So I'll just read out some of the extracts of this clause. It reads that the policy excludes any loss, damage, liability, claim, cost, or expense of whatever nature, directly or indirectly caused, contributed, or resulted from a communicable disease, or fear or threat of a communicable disease. Now, the key word here is indirectly. When we say directly or indirectly, it opens up a Pandora's box. And the concern that insureds and we have expressed is that linking a loss to a communicable disease because of, let's say, there's shortage of manpower, maintenance not being carried out as per schedule, inspection activities being lagged behind, human error. So all of this can be indirectly linked to a communicable disease. And we need a clear stand of the insurance community, the insurer community, to how they will apply this endorsement. So clarity is being sought, and this must be done proactively to make sure that this clause doesn't unfairly apply to losses. The second is the Bi Volatility Clause. Now, the pandemic began in March 2020, or actually in January 2020, but it caught up. It really gathered pace in March 2020. That's when the lockdown started getting announced. You had the first wave, then you had the second wave. In some countries, you had the third wave. And as a result of that, the business interruption exposure has seen dips and it's seen peaks. Now, the concern of insurance companies is if a loss were to happen when there's a peak exposure, there, the payout for VI would be, much more than what it would be in the normal course. So that's the genesis and reason behind the Bi Volatility Clause. What the clause essentially implies is that the exposure, unless it's been declared in advance, will be uniform throughout the year. And any undue fluctuations in VI will not be covered, barring a variance that is allowed in the policy wording. So we've got to be very careful about the clause. What our recommendation would be is to negotiate not having this clause in your VI policy. And if it has to be there, then please declare the fluctuations in advance to the extent possible and allow, negotiate for a maximum possible variance from the average. So that will minimize the impact that this clause has on a payout for a BI loss. The next is the loss prolongation clause. It's not, I'd say, as commonly seen as the earlier two clauses, but we have seen it in a few policies, especially large risks. And the idea behind the clause is that when there are delays in carrying out repairs and replacement, because the equipment cannot reach the site on time, and the interruption in operations is prolonged because of that. So this is excluded by insurance companies, and the reasons why the replacement or the repair cannot be done in time could be because of embargoes, trade sanctions, prohibitions, notwithstanding some of the pandemic prohibitions that we have, and border controls, customs clearance. So all this can prolong the interruption, and that's where the exclusion applies. And the area of concern in this respect is differentiating between normal delays, something that will happen in the normal course, which is indemnifiable, and unindemnifiable delays because of reasons I just spoke about. So differentiating between these delays and bifurcating between what's payable and what's not payable can be problematic, and this needs to be very, very carefully handled when a BI loss comes into play. Now, talking about the current state of the Indian property market, as most of you would be aware, GIC provides a bulk of the reinsurance capacity, and they have prescribed rating as per the IIB mechanism. And IIB has listed 291 occupancies for the Flexa rates. Flexa is the fire, lightning, explosion, and aircraft damage rates with effect January 2020. They're very much prevalent, very rigidly enforced. And what's disheartening is that there's no benefit given for a good claims experience, higher deductible, a loss limit, good physical features, good fire protection for that matter. So none of this is taken into account. You have one rate for one occupancy, and this has really resulted in a premium increase of multiple times as to what it was before the IIB rating came into play. That's before January 2020. Now, this is something that's been strongly contested by insureds, and we as well have really taken up the cause very strongly with GIC, and we pleaded the case to give benefit to good risks for good risk management and good claims experience. Now, we've seen in certain occupancies there is a way out, especially for the large risks. Large risks would be higher than 2,500 crores total insured value at any one location, where you can go to the international market and seek better pricing. Definitely, you would be expected to take on a higher deductible, and you get the benefit of a better premium rate. So depending on the occupancy, you can explore the international market option. And in such cases, there's a huge amount of the risk being reinsured internationally, because the local market will not participate to a large extent. It will be largely reinsurance driven. Another way to minimize the impact of IIB that we have seen is cross-subsidy. Cross-subsidy with other lines of insurance, like marine, like group medical, which can be used to subsidize the increase in property premium. So insurance companies are sometimes willing to look at it as a bouquet of premium. Some of it which is priced as per the IIB, and some of it which is priced based on market forces. So this can be used to minimize the impact of the IIB as well. Now, earlier I spoke about the total cost of risk approach. This is something that we at Marsh have strongly advocated. Now, there are two ways to look at arriving at your deductible and your premium rate. There is the traditional approach, and there is the non-traditional approach, which is the total cost of risk approach. The traditional approach will simply add your deductible to the premium, and your cost of risk is premium plus deductibles. However, the TCOR approach that Marsh advocates very strongly is to take a holistic view of risk, which not only considers your uninsured exposures, that includes your deductible and premium, but also your risk mitigation cost, your internal risk mitigation cost, your external risk mitigation cost, your cost of funding uninsured losses, that is your cost of capital. So all of this put together is your total cost of risk. And when we give you advice on how to manage your risks, it's taking into account the TCOR, the total cost of risk, using all these parameters as opposed to just premium and deductibles. And we feel that's the right way to really manage your risk and design your insurance program. So as you can see in front of you, typically, the total cost of risk will be your retained losses, your premium, and what we really take into account is your implied risk charge, which is the cost of capital, and also the internal and external risk management costs. And this is calculated using an analytics tool called risk financing and optimization. It's an analytics tool. It's an exercise that's been carried out by actuaries, and it's a pretty complicated exercise, and it requires models like the Monte Carlo simulation, which forecasts the claims that you can expect in the future, considering your past claims record, and also unexpected losses, which will go beyond the loss limit. So all of this is taken into account, and this is the right approach for arriving at your deductibles and your policy limits. Now, on this note, I'd like to invite Inayat, who will speak to you about property risk control and some new ideas in this space and how to manage your property risk in these troubled times. Over to you, Inayat.
Thanks, Pranav. Yeah. So as we have seen in our earlier slides of evolving risk landscape, natural catastrophe or climate change or extreme weather event, whatever you call it, is one of the key risks, not only for the advanced economies and also for the emerging markets as well. Hence, it is important for an organization to do an investment of time and effort to understand these risk exposure and also understand the impact of such exposure on their balance sheet. In Marsh, what typically we do is help identify our clients' exposure, not only their own asset, but also their suppliers, third-party contract manufacturer, distribution, all the parties which are part of the overall supply chain. And this really helps in terms of identifying a true risk to the entire business. Now, this type of risk evaluation also includes identifying the cluster of locations which are exposed to a single event impact. A classic example would be in 2011, when we have seen Thailand flooding, which impacted the overall automakers and electronic industry. Similarly, in 2017, what we have seen was a Maria hurricane in Puerto Rico, which impacted the pharmaceutical supply chain, majorly to US. So these sorts type of single event impact can also have a long-lasting impact on the balance sheet of an organization. Hence, it is important to identify such cluster of location. And then once we have identified, evaluate the risk, do the risk quantification of these potential impact. And this typically how we do it is using the industry leading models and new methodologies to arrive at the correct risk quantification. Now, once we have the risk quantified, it is an organization who takes important decision and effort to ensure the risks are mitigated. And at Marsh, we truly believe that we are there to help our client and do a hand-holding to ensure we provide cost-effective mitigation strategy, not at only the local site level, but also at the corporate level, ensuring that they have a corporate level thought process for risk mitigation. And then this type of exercise, what we have also seen, as Paul indicated earlier, have supported a lot of organizations for their ESG initiatives and ensuring that they become more resilient. Yeah, next slide. Now, when we talk about supply chain, and we all know any mass or a regional event happening across the world, one of the important department in organization see has a huge impact is supply chain, and these impact, be it the last 2 years, what we have seen, the pandemic or the weather event, and then the latest or previous geopolitical issues between China, USA, and now of lately in Afghanistan. So all these geopolitical and environmental issues does have a huge impact on the overall supply chain. And supply chain is a complex subject. It involves different aspects, including sourcing, regulation, then you have logistic, then you have external factors, and then also the emerging technology also have paved into the supply chain management. Now, keeping all these different factors into mind, what we have created is a value proposition which typically ensures that we do a detailed supply chain mapping of our client, identifying the critical product and services, including the dealers, suppliers, who all are part of the supply chain resources, ensuring, giving the assessment of qualitative and quantitative, and then identifying the vulnerabilities. This is also a key important thing, identifying the vulnerability and what sort of key measures or control measures we have to control those vulnerabilities. So post identifying, mapping and identifying the vulnerability is the business impact. This is how we do a quantification of a risk through our business impact analysis, not only for the property damage, but also for the business interruption. And then these business interruption can be a direct business interruption or can be a non-damage business interruption. So all that analysis is done through our supply chain mapping. And then we have been successful for a lot of our clients where we help them in improving their supply chain risk management. Yeah, next slide, please. Now, having said about some of the emerging risks, what we all have discussed. Having said that, but we should always remember that we still have to address our traditional risk, what has been there for years. And then earlier, Sanjay, Paul, and Glenn all have indicated, even Pranav has indicated the market hardening issue. One of the key strategy in navigating through this hardening market is your loss prevention and safety measure, what an organization does it. And this is pretty evident with one of the survey which was done by RIMS for the underwriters. And then that survey clearly indicates the importance of property loss or a loss prevention initiative a company takes, and how those loss prevention measures impact or the underwriting decision of an insurance company. So it's evident that the loss prevention measures taken by a company will result in a high level of risk tolerance. The risk, what a client has or an organization had, becomes more attractive to the insurer. And then with risk mitigation and risk transfer efforts, and it's a balance what we have seen again in previous slide through TCOR. Once we do that risk management through risk transfer and risk mitigation, it is the high return of investment what a client gets over a long period of time through these efforts. Now, when we talk about these loss prevention model, it is not only a single subject. It is a wide subject. Some of it includes, your property loss prevention, logistic risk management, fire and life safety, nat cat exposure, even a code compliance. Then you have new project, greenfield, brownfield project, which are coming, how you are doing the risk engineering to it. As again Paul said earlier, cyber risk consulting, how cyber risk, how we are managing it, business continuity plan, or the enterprise risk management. All these aspects are part of a loss prevention activity which needs to be managed. And at Marsh, we have a dedicated team who ensure that all these subjects are addressed by our team locally, as well as we at Marsh have regional resources as well. So we typically take help from them as well. So you get in return a high quality service from a consulting perspective. And this has been utilized by a lot of MNCs, including a lot of beverages and food industries, a lot of engineering industry, hotel chain, chemical, pharma industries, and Japanese, automobile industries. So all have utilized and seen the impact on a long run, how it impacted in terms of return on investment, and also the improvement of the safety at the corporate and at the site level as well. So yeah, so that's pretty much from my side. Next slide, please. So we have now a panel discussion. So Sahil, over to you for the panel discussion.
Thank you, Anayat, and good evening, everybody. So thank you to our speakers, Sanjay, Pranav, Glenn, and Paul, as well as Anayat, for a very insightful presentation. In the next panel discussion for the next couple of minutes, we have a couple of pertinent questions which have been there on the top of the mind of majority of our clients. So we would be sharing those with our speakers here to seek their views on that. So in addition to Paul, Glenn, Pranav, and Anayat, we are also joined by my colleague Gaurav Pagare. He's the head of placements at Marsh India as a part of the panel discussion. Okay, so Ladri, could we switch on the spotlight, please, to the speakers? Yeah, so Paul, so my first question is for Paul. So Paul, we've seen that the property market in the last 3 years has been hardening significantly. So what is the outlook for the next 12 months?
Yeah, good question. So you'll have to give the answer for the India domestic market. I'll give that answer for the broader Asia market. So obviously we've had 2 years now of rate increases for property policies, very much D&O policies, very big increases. Cyber has been increasing, and the general liability classes are starting to increase. And then even within the property industry, the rate increases have been quite extreme, actually, in the energy industry in particular. Now, that's really been driven by the very poor loss experience of the big international insurers in recent years. So they've run at a combined ratio, which basically means that for every dollar of premium they're taking in, more than $1 is going out. So that's obviously not sustainable for them. But the good news is that following the rate adjustments they've made in the last couple of years, we can now see from the quarterly reporting that these big companies are back into profitability. So they're back into profitability. So now there is pressure to bring those rates down again. It's a supply and demand game. So what we're experiencing is generally this year in Asia, the rates are still going up, but the percentage increase is not as big as it's been in the 2 previous years. So unless we get hit with any unless there's a very bad season in the US for hurricanes, we would expect that that trend continues. And then we have an easier market environment, at least for the property classes, going into 2022.
Thank you, Paul. So thank you for sharing. And it'll be interesting for the clients to also note that, yes, while the uncertainties still continue, but yeah, there is a ray of hope that we would see some improvement in the market. So my next question is for Pranav. So Pranav, from the Indian context, we've seen that in view of the ongoing pandemic, the markets have become quite rigid. And that's especially in terms of the policy wordings and the coverages available. So what, according to you, would be the best strategy for a client to get the broadest cover in such a hard market?
Sahil, very good question and very relevant in today's context. So gone are the days when insureds had the luxury of buying a laundry list of extensions with the highest of limits and the broadest of policy wordings, clause wordings. So in today's scenario, insureds have to select the policy limits, the add-on limits that they require, rather than buying unnecessarily high limits. The clause wordings again need to be, relevant to their risk and cover what's required rather than just give the broadest possible coverage. So clearly you've got to buy what you need rather than just buying something that's just extravagant and too broad because it's going to cost money. So each extension costs money as opposed to things, coverages that were just thrown in free of cost maybe 2 years or 3 years ago. So one has to be prudent when arriving at add-on limits and add-on clause wordings. I think that's the way forward, at least for the next 12 months.
Great. Thank you, Pranav. I think that makes a lot of sense because with the changing risk landscape, having the most suitable cover in place is very relevant for clients. So, moving on, Inayat, so my next question is for you. So, keeping in mind that the ongoing pandemic has actually disrupted the operations for several manufacturing facilities, what has been the loss experience during these times, especially from a fire or an equipment damage perspective?
Sahil, before really, give you the correct, sort of a view on that, some of the key statistics we need to understand is in last 12 months, from May around 2020 till now, there has been around 116 industrial accidents, what Indian chemical and mining industries have seen, okay? And there have been more than 230 workers who died during these accidents. And then some of the key accident, which we all know is well-known accidents are our toxic gas release in Vizag, all of the boiler explosions, what we have seen in some of the thermal power plants, and then fires in pharmaceutical industry. Now, one important aspect, which is sort of common to some extent to all these events, is all these events have happened either during a startup or shutdown. So when an organization who's coming out of COVID and starting their plants, it's very important to ensure they do a startup and shutdown in a most safest manner to ensure that these type of events are reduced. And hence, this will really ensure that the profitability and the resiliency of a company is ensured in this case, if they do that.
Thanks, that's very insightful indeed. Glenn, just addressing my next question to you. So you touched upon the topic and how relevant contingent business interruption is. So we've seen that the coverage for contingent business interruption has been a sore point in which insurers have usually resisted giving, say, bespoke coverage, especially beyond the first tier suppliers. So from a claims perspective, how critical do you see this aspect of coverage, and especially in light of the recent losses?
Well, certainly getting the right level of cover for CBI has been a challenge, probably for around 10 years now. Back in 2011, there were two major events that really caused this. So there was the Japanese tsunami in March 2011, and then that was followed by the Thai floods in the fourth quarter of 2011. And both of those events had big impacts on customers and suppliers cover, not just in Asia, but really around the world. Insurers never really thought about such aggregation of CBI exposures before, so therefore they're bringing in lower sublimits. And what they're doing as well as that is they're limiting cover to flexer quite often, and also trying to restrict cover to just tier one, as you mentioned, which is just direct customers and suppliers. And that does create issues. So there was an example case study that we use in a lot of our training that relates to this specific issue in the energy industry, where, without going into too many details, the insured had to suspend their operations due to an event at their gas supply, which caused an inability to actually supply the gas. but the gas was transferred from the supplier to the insured via a pipeline. And that pipeline was the subject of a different contract with a different service provider. So when assessing the claim, insurers denied the liability as the insured only had first tier cover, exactly how you point out. And therefore that only covered losses arising from damage to the actual pipeline. So any losses from the gas producer would require second tier cover, so supplier to supplier. In that case, therefore, the claim was rejected. So that's a typical example. We've seen it many times. In conclusion, I'd suggest that clients really need to try and get multi-tier CBI cover for all risks if they can. But look, we all know that is incredibly difficult for all my broking colleagues out there in the current environment. But that's what we'll try to aim for. So from a claim perspective, that's certainly the gold star.
Thank you, Glenn. I think it clearly reflects that yes, leaving these tier 2 or tier 3 suppliers untouched would leave a lot of unaddressed exposure on the balance sheet for the client. So I have an extended question for Paul. So Paul, while contingent business interruption has been an area of concern, we've also seen that non-damage business interruption is gaining a lot of importance. So what's the current position from the market's point of view in terms of giving coverage for non-damage business interruption?
Yeah, okay, good question. It's some of the non-damage business interruption will relate to some of the emerging risks that I talked about earlier. But let me say it's not straightforward. It's not like there is an off-the-shelf product with significant limits that is available to clients. But insurers do have an appetite to develop bespoke solutions. But as you can imagine, there is a lot of work that needs to go into that, a lot of information that needs to be provided to the insurers. The area related to that is very, very clearly expanding is so-called parametric coverages. So instead of the trigger being the actual damage to your facilities or the actual calculated business interruption loss, the trigger for the insurance is some event occurring. So it would be, for example, an earthquake of a magnitude of X within a certain radius, and then the policy pays X. Or it could be similar for flood. Flooding of a certain level in a certain area triggers the policy and the policy pays. So the most likely area is going to be in this pandemic arena. It's not that big, but it is very, very clearly a growing area.
Thank you, Paul. So non-damage business interruption is certainly another emerging risk. And as you rightly mentioned, we do have solutions, though restrictive, but there are some in place. So Glenn, I'm going to come back to you. So we've seen that we do expect that business interruption claim calculations are expected to get a bit more complicated in the current scenario, especially because the interruption is getting prolonged on account of the uninsured losses. So what are your thoughts on this scenario?
Look, they certainly are getting more complicated, certainly in certain regions. COVID is causing difficulties because indemnity periods are being stretched longer, and actually getting the reinstatement of damaged equipment and damaged buildings and things is taking longer to do. So that whole stretches the whole process. But really having these concurrent uninsured losses is nothing new. We always expect that. So I've been doing claims for many, many years, and the job of a claims preparer and the loss adjuster is to try and determine an appropriate split between these uninsured losses and the insured losses. Having those concurrent events all at the same time is just part of the normal process of actually preparing a claim. Nothing new. Certainly COVID is probably making it more challenging, but it's one of the reasons why ultimately we get asked to help our clients prepare claims. It's specifically to tiptoe through all of these challenges to come up with what the real loss is so that they can maximize recovery.
Thank you, Glenn. That's a very insightful view on the methodical approach towards the claims. So my next question is for Gaurav, and Gaurav, this is something which will be very of a lot of keen interest for our clients on this session right now. So we've seen that there are constraints in the local market in India because of the file and use guidelines which have been put forth by the regulator. So what, according to you, is the degree of customization and coverage available to an Indian insured despite these constraints available?
See, there is a use and file system which is there in the system in India. But although most of the Indian insurance companies, the direct insurance companies, have the treaties with the GIC, and GIC have some set of wordings, coverages, which actually restricts them to offer the higher coverages. So frankly, the challenge over here is that even though we want to customize the wording, even though we want to give clients additional cover extra, and as per the requirements of the customer, the insurance companies are restricted because of their treaties, and Indian insurance companies mostly work on the proportional treaties. So that's one of the constraints why they are unable to offer better coverages or better wordings. Although there are some solutions available, but not exactly as per the requirements of the client. Some client needs much better coverages, but today that's there is restrictions available in the market.
Thank you, Gaurav. That's still a ray of hope for the clients here. My next question, Inayat, is for you. So, what, according to you, should be the strategy of a prudent insured with respect to loss control, keeping in mind the hardening market scenario in India, especially for large risks, which today are even requiring international reinsurance capacity?
Yeah, so Sahil, the biggest difference, what typically we see in India and the international market is the risk quality approach, whereas Indian philosophy of insurance is on the occupancy fixed rate concept, whereas internationally it is more driven on the risk quality. Okay, and hence, when we talk about risk quality, we have lot of Indian companies fail to attract a lot of insurance internationally. And then one of the key reason is although the occupancy could be as simple as a machine shop, but the risk quality is so bad that, a lot of insurance fail to, do not really want to abide with them. And another important side of this is we have seen a lot of complex and then high hazard occupancies, which has a very good risk management. And then even though, was difficult to get the terms, there were a lot of insurance companies who were happy to, support that client because they had a good risk management perspective. So it is, I cannot emphasize more what Paul, Pranav and Sanjay have emphasized, and Glenn has emphasized on the loss prevention perspective, the risk management, which is utmost important when we go to international market for the insurance purpose.
Thank you, Nayat. And I think so. If I just summarize, basically, a good, robust risk management practice of the organization would increase their prospects to get better solutions from the international market. So, Glenn, I'm coming back to you again, and this is back to business interruption, our theme today for the topic. So, according to you, what difference would forensic accounting make, especially to business interruption claims payout?
Look, I'm a little biased, but I think it makes a huge difference having a forensic accountant to actually prepare a claim. If it's a small claim, then okay, maybe a forensic accountant not required, but anything on the larger side, huge amount of value that can be added. What you will find is that on any claim of any reasonable size, the insurer will have a forensic accountant to look after their interests. And they have the specific objective of minimizing insurers' exposure. So we find if our clients don't have that same representation from their own forensic accountant, then there's no question that they'll be disadvantaged and they would suffer reduced payouts as a result. One example that I often give is a claim we did in Japan a while ago, where the insurer believed that the exposure was only around 10 million, having their forensic accountant having poured over all of the data. But we actually were able to convince them that actually, no, the exposure was about 100 million, like 10 times the amount. And the final settlement was exactly how we pitched it. And an incredible difference. Now, obviously, we can't guarantee a 10-fold increase every time we get engaged, but no question that when a forensic accountant gets stuck into these claims, we're able to articulate exactly what the losses should be and how the claim should be presented. And ultimately, the settlement is much larger than if no forensic accounting is involved.
Thank you, Glenn. That clearly reflects a lot of value in forensic accounting. And thank you for sharing the example from the Japan claim. Pranav, my next question is for you. So according to you, how should a prudent and progressive-minded insured go about fixing their self-insured retention?
Yeah, thanks, Sahil. And a part of this was covered in the presentation. It's important for a prudent insured to assess his financial strength, the amount of loss he can take on his balance sheet without severely impacting the operation. So the first step would be to carry out a risk tolerance exercise, and the next would be to arrive at an appropriate deductible using the total cost of risk methodology that's been explained earlier. So this will arrive, at a proper deductible, something that's meaningful, not too low and not too high. It would, ensure that the deductible is to an extent that will allow a healthy premium, and also, a risk transfer, which is meaningful rather than, grounds up. So I feel that's the way it should be done, Sahil.
Thank you, Pranav. So that's a scientific approach which will make the maximum amount of sense. So I'm going to extend this question further to Gaurav. So Gaurav, do you think that the regulator is likely to allow a lower premium rate for selecting higher policy deductible in the months to come?
So, Sahil, frankly, this is not a regulator issue. Regulator has freed the wording and the rating long time ago. It's almost like a decade or more. It's more, again, coming back to this thing again. So we have only one reinsurer, which is GIC of India, and GIC of India is mainly controlling the entire insurance market, I would say. There are other FRBs, etc., but they're all working as per what GIC manages. And the most of the insurance companies, their treaties again are with GIC. So the rates which are getting, and they've tested the success, frankly, with this IIB coming from last 2 years. This discussion is going on. There are various papers have been issued to GIC, to regulator. Regulator knows this is a challenge, and this is a so-called a backdoor entry of a tariff, but they don't have much to do with this. They say, because GIC says that this is my minimum rate, you may not cede the premium in my treaties if you're not using this rate. So that's the challenge. Although there are various forums, various bodies which are pushing them. We have, as Marsh, as Broker Association, we also sent some papers to them that this should be freed up. They should allow discounts for higher deductible, for good risk, good claims management, better claims experience, and all this thing. But it's in the discussion. There were some changes with the council. Now looks like they may come up with something soon. There was some discussion earlier also. Let's see. Hope for the best. There should be something which should come up.
Thank you, Gaurav. And my last question, Inayat, is to you. So Inayat, you touched upon the importance of having a very robust risk management practice. So due to the pandemic, we've seen that virtual surveys have been widely carried out in the past couple of months. So what, according to you, is the way forward in this regard, especially when life gets back to normal?
So, Sahil, virtual survey was the need of the hour back in last 2 years, and then it has, delivered what it was supposed to. We have seen several renewals happening, and then it was perfect. But then there are so many limitations to a virtual survey which cannot be, addressed. So when we do a physical survey, I'll give you a classic example. During one of our virtual survey, during our normal surveys 2 years back, we have seen that the site was exposed to a NatCat exposure, a flood exposure. Now, if we do a virtual survey, we will assume that it is exposed. But when we did the actual site survey, we concluded that although as per modeling, it is exposed to flood, but in reality, because of the site elevation and whatever other reason, the site is not actually exposed to flooding. So those sort of clarity can only happen during an actual site survey, and that's where I feel, particularly for high challenge occupancies, a physical risk evaluation. I won't even say a survey or an inspection. It is a risk evaluation which is sort of a mandatory to be done. Virtual survey can still be there as for a lighter occupancies, but yeah, for a high challenge, I think physical survey, risk evaluation is a must.
Thank you, Anand. So that basically means that physical surveys will still be very important, but virtual surveys are there to stay. So thank you very much to our entire distinguished panel of speakers for participating and answering these very pertinent questions. We would now like to open the forum for the audience for the Q&A session. So I can see that in the Q&A tab, we have a question which is coming from Ms. Divya N. So I would like to pass on this question to Glenn, because this is specifically being is actually on business interruption. So Glenn, can you please elaborate on how to deal with BI loss if an event occurs towards the end of the policy period and the projection values shared to insure BI were the annual figures for the year insured?
Sure. Look, realistically, the way that we would calculate a claim would be the same, irrespective of how the declared values are calculated. We have to assess what the performance of the business would have been from the date of loss for the indemnity period looking forward. Now, one of the problems might be that if the declared values for the period of insurance, which is earlier, then there could be a problem with underinsurance, and therefore the client would suffer from average. So what I would always recommend is during that process of actually calculating the declared value, you always look ahead. So you have a think, if it's a growing business, what if the loss happens on the last day of the policy period? Therefore, you won't be underinsured. If it's a seasonal business, you need to think, okay, well, where's the maximum 12 months during that period? So always thinking to make sure that your declared value is always adequate, irrespective of where that loss happens during the policy period. Okay, and if you do that, you should avoid underinsurance.
Thank you, Glenn. Divya ma'am, I hope Glenn's comments have answered your question. So any further questions? We have the Q&A tab open. If any of the participants would like to ask a question live, please click on the raise hand button and we would unmute your line so that you could speak out your questions. So Pranav, if I can pass this on to you further while we wait for the questions from the audience.
Typed in the Q&A tab.
Yeah, I can see a question from Mr. Palit Shukla. So Mr. Palit Shukla, thank you very much for this question. Glenn, I'm coming back to you again on this. So Mr. Shukla has asked that the business interruption, as far as BI is concerned, how is work in progress stock treated when they are salvaged during the interruption period?
There could well be an adjustment for any benefit that you would get from any work in progress stock. So if it's purely variable costs that you get paid for as work in progress, then that's no problem. You can have your stock and your business interruption and there's no duplication. But to the extent that there are any fixed costs or any profit that is actually recovered as part of your work in progress claim, then you can't also have it in your business interruption. Otherwise, you're recovering the same thing twice. So there will always be an adjustment to make sure you only get it once. Okay, hope that answers the question.
Thank you, Glenn. I hope Mr. Shukla, Glenn's comments have answered your question. So Niladri, if I can request you to possibly unmute Divya ma'am's line, because I think ma'am has a question. She has an extended question to one which is being answered on by Pranav.
Yeah, you asked me to elaborate, and I can just share that.
Yeah, unmuted Divya ma'am's line. If she can unmute herself.
Yeah.
The question.
Yes, Divya. Yeah, you would
Divya
like
ma'am.
to try to microphone.
Hi, Pranav.
Yeah, hello, Divya.
Thanks for answering my question. I just wanted to check what are your general thoughts on integrating the local PDBI policy with a global master policy, because as you will be much well aware that the deductibles would almost be at least 4 to 5 times. That's the minimum. So if you have a 10 lakh deductible on a local IR policy, we can expect anything between 80 lakhs close to a crore on a master policy if it's integrated. But like Sanjay mentioned initially, there is a lot of customization that's available on a global policy. And after COVID, there are more restrictions even on the IR policy. So we can expect to have a wider coverage, but there's also the chances of a lesser claim of, let's say, a 50 lakh or something which is lesser than a crore that will not be covered on the policy. So what are your general thoughts on that?
Yeah, thanks, Divya. And my answer is going to be more towards the benefits the company will accrue at a group level, at a global level, as opposed to an individual country level. So we are advocates clearly of consolidation, having a global program. We believe that consolidation gives you the economies of scale at a global level. So if you look at it country-wise, there may be certain countries that benefit, certain countries that have to pay a bit more premium. Same applies to deductible. But when you consolidate, clearly there's greater uniformity, control, you're using the economies of scale, you're getting a broader coverage, and deductible can be minimized to a certain extent. If a certain country really prefers a much lower deductible, it can be worked out, but you're right in your assessment that it's generally higher than what you get for a standalone local policy. So the local market clearly, will have a lower deductible. It could be, a slightly narrower coverage, considering each country, has their own peculiarities, concerning its market. But at a group level, at a holistic level, if it's a large conglomerate, there are certainly benefits in consolidating. Having a global approach is a more evolved way of designing your insurance program. That's what my answer would be. So it's always good to look at risk management for the conglomerate as a whole rather than country-wise. I hope that answers your question, Divya. I'm happy to shed some more light if required.
Sure, thanks, Pranav. Those are the very points based on which we were considering doing that. Just wanted some additional inputs as well, but thanks a lot for your answer. Thank you.
Please feel free to write to us, Divya. We'll be happy to connect and share some very specific thoughts as well.
Sure, thanks.
Yeah, most welcome.
Thank you, Pranav, and thank you, ma'am. So I'm just being wary of the time, and we'll take one last question. But yes, our entire team and your local Marsh representatives will always be available to answer any questions that you have. So Paul, I have this one question for you from Mr. Kapila Gunatilake. He is asking that, are there any non-damage BI covers available in the international markets? He understands that Munich Re has bought out some for selected brokers. So Paul, if you could share some thoughts on this.
Yeah, I think back to my commentary earlier, the most prominent form of cover are the parametric coverages, but they can apply. So anywhere where you have a trigger that can be measured from an independent source, there is potential to create a policy. And you're quite right. There are a number of underwriters in the region. There is a company called Descartes, DESCARTES, which is actually an offshoot of Generali, that are really building up their resources in Asia to write more of these parametric coverages. So as I said, they are things where you need an independent trigger. So it can cover earthquake, but you have an independent monitoring of the intensity of the earthquake. It can cover flood, but you have an independent monitoring of the rainfall in those areas. But anything where you can have an independent measure that becomes the trigger and it can be modeled, we can develop covers. So again, as I said earlier, It's not a huge market, but it is very much a growing market. And Marsh is actually hiring resources in Asia to focus on this work. But I think the answer is that you won't buy it off the shelf. If you have a specific area where you are looking for cover and you want us to work with you to build something out, then again, please contact the India team.
Thank you, Paul. And Kapila sir, I hope this has answered your question. As Paul mentioned, the Marsh India team is always available to support you on these requirements. So Pranav, over to you for any closing remarks from your side.
Thanks, Sahil. And there's been a tremendous amount of knowledge that's been shared by the panelists and some very pertinent questions by the participants. So thank you everyone for joining. And we will be having more such webinars, knowledge sharing sessions. The idea is to disseminate knowledge and best practices. Look forward to your continued participation. On this note, I'd like to end the webinar. Thank you again and look forward to meeting you soon. Bye and take care.